Well, on that note, let's invite our next expert, someone from the markets. Amar Ambani, the head of research at IIFL, is joining us now for some advice on how to fish in these somewhat troubled waters. Good morning, Amar. Thank you very much for joining us. For the longest time, we get requests from viewers asking us if the markets are, 10-14% lower than their March highs, what do we do? Are you net a buyer at this point in time, and which is the category that is most attractive?
So, as an investor, I would say that I would definitely be a buyer in this market. I would keep looking at, stocks beyond the index where, there's handsome money to be made. But it again depends on, what is your relationship with the market. So like we mentioned in our strategy note, if you're a trader, then obviously these are extremely tough times, and I think the rest of this year and possibly the rest of FY16 is going to be that way, because if you're a trader, if you're somebody who is going long or short on the market, then there are so many event risks currently, and not to do with our economy really, but abroad, that you could have an event that takes place in the evening and next day your stop on either side is taken out. So I think there's going to be extreme volatility. And on the liquidity front, things have gone real bad. At this point, even when we talk to a lot of, these savvy investors, whether on the fund management side or the HNI side, they really don't know what to do, because, at this point you have FIs selling $70 to $100 million a day, barring the odd day when they were buyer like recently. And then, there is this risk that sovereign wealth funds also may pull out. And in the recent past, when you saw FIs pulling out, at that point, there was a situation which we've not seen for a long time, and which was that HNIs and DIIs were buyers, and they kind of offset FIs. But going forward, we think that maybe that might be difficult, because there are a lot of tax-free bonds also coming. So given the state of the market and the situation globally, a lot of these HNIs might now look for tax-free bonds. So if I'm an investor, yes, I'm surely looking for picks, but traders going to be a tough time.
Okay. Amar, hi, good morning. So let's talk about some sectors now, because the sector of the year clearly has been pharmaceuticals, and even in trade today, some of these pharma names are big gainers. Would you advise buying, names like Sun Pharma, Lupin, taking fresh buy positions in these names for the longer term?
So I think if you have a longer term horizon, then these large cap stocks that you mentioned should surely be on one's buy list. I think pharma as a sector is clearly a sunrise sector. There's huge opportunity abroad. We've of course seen some problems more recently in the last few quarters when it comes to the slow pace of regulatory approvals, or the US FDA coming down on some of these manufacturing facilities. But I think other than that, there is a lot going for this space. To add to that, even tactically, if one was to take a call, then rupee depreciation will clearly help these companies. What some of our investors are a little concerned about is the level of inorganic growth and acquisitions which is taking place in this sector, and how that will pan out, because these are large bets that some of these players are placing. But I think given the track record, somebody like a Sun Pharma you mentioned, of how they've been able to turn around companies in the past, there is no reason to at this point believe that they will not be able to handle these acquisitions. So yes, big money is going in, but I would definitely at this point stay put with whichever pharma stocks that you mentioned.
What about the auto ancillary space? We got this engineering exports number which looked very shocking, right, fallen by 30%, and we've already seen a lot of falls in Bharat Forge and Motherson Sumi. Do they become attractive now? Do you buy them in distress?
We would be buyers here, because there is not as much clarity with the auto space, but there is a lot more clarity with the auto ancillary space, because in the auto space, even if a segment is doing well, competitions increase. For example, in two-wheelers, you now have to contend with a couple of more players than in the past. So maybe market share of some of the listed companies might fall, but what happens with these auto ancillaries supplying to even the other unlisted companies, they're going to benefit with not just revival in growth and festive season coming up, but also the replacement market. and the fact that there are new kind of models which are being launched. The intensity of model launch has gone up compared to many years ago, because especially in this market, people want new, and at the same time, I think the shelf life is a lot lesser. So the requirement for different parts, for better parts, so even realizations are higher. So I think auto ancillaries will benefit, and input costs for a lot of these companies are coming off, and that's the big positive. So along with even say a 15% kind of growth on the revenue front, if margins expand by even 2 or 3 percentage points, and I'm being conservative here, then in that case you can see a big jump in earnings growth. So auto ancillaries is a pack that you must look at.
Okay. From the private sector banking space, which are the top banks that you would advise buying into now for the longer term?
So in financials, actually, there are NBFCs also that we like, but I just restrict my views to the large cap banks. So in that, I think in the private banking space, we are clearly overweight compared to PSU banks. And within that, you have the HDFCs and Axis Bank, ICICI, which are growing at a much faster rate than what the system loan growth is, and their asset quality is much better off compared to the PSU space. We don't believe the worst is over as far as asset quality is concerned for banking, but I think if I had to pick, then I would be a lot safer with private sector banks. So you have the ICICI growing at 15-16%, some others, HDFC growing at 20% or more, and that's if you're growing at this point, if the system growth is 10% and you're growing at 15 or 20%, that's huge market share gain while maintaining asset quality, and it's on the retail front. So I think we're pretty bullish on the private banking space.
Okay, and finally, Amar, you and your team have a very sharp eye for mid caps, which you can't put in any particular category, but which simply have consistency of performance, low leverage, good cash, just good companies, run a good business irrespective of the sector. Is there anything that you would look out for at this juncture, which has swum into your radar?
There are lots actually, Lata, but unfortunately I wouldn't want to get into names. But more recently, just a few days ago, we did come out with a buy report on one of these gold loan companies, where we thought it was a value pick because valuations are a lot cheaper and things are stabilizing there, and they've diversified as well. So we're quite happy, and our investors are quite happy with that call, but I wouldn't want to get into more specifics.
All right, then we'll leave it at that. Amar Ambani, it was a pleasure speaking with you. Thank you very much for joining us. Enjoy your Ganesh festivities. Well, let's do one thing. We'll take a break on that note because the markets are actually sticking on to where they were.